to the Valuation Master Class case study, where you'll learn about interesting stocks and how to value them. What's interesting about Globe Telecom is that its FinTech investment could be Philippines' first or Philippines' unicorn. This is Andrew Stotts of the Valuation Masterclass. Let's get started. This information is for learning purposes only. It's not investment advice or a recommendation. Let's look at Globe for a minute. Globe is a Philippine communications sector company. We used to call it the telecommunications sector, but now it's the communications sector, thanks to a change by MSCI. And it's Philippines' largest mobile network operator with a total mobile subscriber base of 78 million, equaling about 52% market share. Now, there's three things to know about this company, and we're going to go into those three things in more detail. So the first thing to know about this company is home broadband expansion offers solid top-line driver. New entrant, ditto, challenges previous Filipino duopoly. And investment in mobile payments could pay off big. The key statistics, there's 12 analysts covering the company. They have a hold recommendation. The PE ratio is about 17 times, and dividend yield is about 3.3. My value estimate is 3,472 Philippine pesos. That's upside of about 11%. Welcome, everybody. If you are joining us from around the world, I see Hillary from Nigeria. But welcome, everybody. If you have questions, make sure to put them in the chat, and I'll do my best to answer them. So, first of all, mobile, if we look at the revenue structure of the company, mobile revenues account for 62% of total revenues. Home broadband is 18%, corporate data is 8%, and fixed line voice is 2%, and then there's non-service revenues that's about 10%. So the share price rally could come to an end based upon some technical signals, right? The share price already, as in August 2021, Globe saw a massive 50% plus share price increase. And the increase is mainly attributable to positive news about its latest FinTech investment, Mint. The 50-day moving average stayed well above the 200-day moving average as that rally was happening, but it seems like it's about to fall. So from a technical perspective, it looks a bit weak. So volume RSI has been weak recently, and hence it does not provide any support. Let's look at the story. First, home broadband expansion offers solid top-line driver. In 9 months, 2021, Globe recognized 3.7 million broadband subscribers, which is an 85% increase compared to 2019. The rapid increase was attributable to its accelerated rollout of fiber. In 2021, it reached 1.4 million additional households with its fiber network. And currently, revenue from broadband makes up 20% of its service revenue. And I know myself, I just got fiber here in my Bangkok office. I got a second fiber. First, we had one fiber service that was able to get to this to my home office. And recently, the new AIS fiber was able to get here. So I've got both of them, and I've been testing them. But I can say that, man, when you get fiber in the home, you're never going to get rid of it. So the CAGR growth in Globe's broadband subscribers is almost 30% average annual growth. So massive subscriber growth. Now, heavy investments are required to stay ahead of the competition. I'm looking at a chart here that looks at the level of CapEx, first of all, which has risen in 2021 almost to 100 billion pesos, and that's been just rising over time. As disposable income rises in the Philippines, I expect households to have both a fixed broadband connection at home as well as mobile connection for family members. Therefore, mobile operators must extend their network coverage. And accelerating expansion is necessary to avoid losing market share. The situation is competitive. And the new entrant, Ditto, is challenging previous duopoly. Now, the Ditto consortium is 40% China Telecom, and then the remainder by two separate companies that actually, I don't know the origins of those companies, but I would assume that they're Philippine companies. Now, in March 2021, the China-backed company Ditto started its commercial operations. Throughout the past year, it's already acquired 5.3 million subscribers. Annual capex is more than 50 billion pesos to expand network coverage fast. For 2022, Ditto targets to double its subscriber base to 12 million, which means it could steal subscribers from Globe. Now, here's an interesting thing about new entrants into an industry. When you think about it, I would say that if you look at new entrants into an industry, the question is, can the new entrants leapfrog the existing competitors? What does it mean, leapfrog? Well, a great example is when I came to Thailand, the number one government contract that was on offer, every company was bidding for it, and the winner won a huge prize by getting this. And it was in 1995 to win the concession to lay the fixed telephone lines around Bangkok. Now, just as they won this, one of the companies was True, another one was TOT, others that, or what was it? I forgot the name of it, but it ended up merging with TOT. But the point is that it seemed like it was a great opportunity. And so they started expanding into fixed lines. And then what happened was mobile came out. And mobile was able to leapfrog fixed lines. So in Thailand, we have a company, AIS, Advanced Info Services. And the reason why it's always been ahead of True in the past was because True got the fixed line contract. So then they got the mobile and they were burdened with this massive cost for fixed lines. So it's kind of interesting now to see that Philippines, as an example, Thailand also is back at laying down fiber and fixed lines, but now they're doing it at a much higher level of profitability. But anyways, the point being is that can this company Ditto leapfrog existing players? What do you think? Well, I would say, yeah, maybe, maybe not. High mobile penetration means intensified competition. Mobile subscribers and the population, well, here we can see that about 150, with around 150% mobile penetration, which is already very high, I don't see the subscriber base rising that much. Population is pretty steady. This means that mobile operators need to sell more to current subscribers or win over subscribers from competitors in order to realize further growth. The entrance of Ditto makes the market more competitive. So I would say that Ditto doesn't really have technology that's able to leapfrog the way that AIS in Thailand was able to do when it was competing with True. Why don't we take a moment here and answer the question, what are the ways to grow revenue? Well, revenue growth is a key success factor of any business. Simply put, revenue equals price times quantity. Therefore, to increase revenue, a company must either sell more of its products or increase the price of its products, or some combination of both. Now, one way to increase quantity is to bring new products to the market. This is what cell phone companies have been doing when they've been rolling out fiber optic networks. They're bringing in new products. So remember, if you've got questions, bring them into the chat. Feel free to ask. Welcome Lee to the presentation. Lee says, I read that Ditto owner is very friendly with President Duterte. Yes, that's quite possible. I seem to recall that too. Is the next question comes from Tada, and that is 2022 profit going to grow over 2021? I'm going to show you the answer to that as we get down deeper into it. Now, let's go into point number 3, and that is investment in mobile payments could pay off big. Here on the right, I'm showing you a snapshot of an app called Gcash. Globe bought a 40% stake in Mint, a FinTech firm engaged in mobile payments and microloans. Mint operates with Gcash, the largest e-wallet in the Philippines. Gcash's user base and number of merchants is growing exponentially. Everybody's using it. In third quarter of 2021, it recorded 51 million users, up 10 times compared to 2019. Keeping in mind that the population of the Philippines is roughly about 100 million people. Thailand's population is about 70 million. The difference between the Philippines and Thailand is that Philippines population is much younger, almost by half compared to the Thai population. So you definitely have high growth there in the Philippines. As a comparison, the aggregate of all e-wallet competitors is only 41 million. So Gcash is really expanding massively. So Gcash was ranked in Credit Suisse's Southeast Asia 35 unicorns list. Gcash dragged profits in the past, but turns now into a big driver. So in 2019 and 2020, Globe recognized more than 4 billion equity loss from its investment in Mint. However, in 2021, Mint started to record a profit, and this could grow exponentially. With a current valuation of 100 billion Philippine pesos, Mint is considered Philippines' largest unicorn that could be ready for IPO in 2022 this year. That could be a big boom for Globe. And finally, I expect the investment in Mint to be a key long-term profit driver for Globe. Now, Peter, welcome, and thanks for the question. And the question from Peter is, let me just go to that question. The question is, would it be possible to reduce the price so much that the income also decreases if they only look at increasing their revenues? Would that be a bad thing for the company share price? So basically, you generally don't want to decrease your pricing to a point where you're losing money. Some companies will do that for some strategic purpose, but generally that doesn't happen very often. And so I would say it's not going to happen in this case either. Now, scan the QR code to go to the Valuation Master Class.com and blog to download all full case study reports for free. This one is usually up within 24 hours. You can also just go to the link in the show notes or in the notes below. Now, let's go through the FVMR scorecard about this company. It measures a stock's attractiveness relative to all other companies. Attractiveness is based upon 4 elements: fundamentals, valuation, momentum, and risk. The scale is from 1 best to 10 worst. So here, what we can see is if we look at the company, it's got strong fundamentals and we're riding with the momentum. There's a lot of debt in the company because they have been expanding. But let's look at that momentum a bit here. What we can see is that there was a 78% price change in the last 6 months. That's a major driver of momentum. Now, recently, I created a short online course explaining my FVMR investing approach. And I usually sell it for $97, but for a limited time, I'm offering it for free. Just scan this QR code or go down to the links below. Lee mentions that Mint and Gcash look promising. I think so. I think there's a lot of potential there. And I know from my friends in the Philippines and my former students that they are using both Gcash and Mint. Let's look at the forecast. So there's 12 analysts covering the company. There's a 1% upside. And the majority of analysts stay with a hold recommendation, while 4 analysts have a sell. So basically, analysts have turned negative. Now, part of this depends on what's your time horizon. From my perspective, I'm always looking a little bit longer term than just trading. We've seen in the technical charts that the stock has, had quite a run. But I would also say that there's a lot of value there, and the value that could come out from a listing of Mint could be significant. Now, also to answer the question that came from Tada, to answer the question you asked, would there be growth? Well, there's definitely revenue growth of about 5% in 2021 and 5% in 2022 is what we're expecting. I don't actually have the net profit growth here. Maybe I should add that to this chart. Good question. So consensus expects solid single-digit revenue growth for the future. Also, margins are expected to stay stable. So let's now look at the growth in the P&L. Now, I'm looking at the profit and loss statement, and I can see that there's been nearly more than a 4 billion, almost a 5 billion Philippine pesos in losses from their investment in Mint, and it's likely to record a profit in 2021. We've already had a lot of profit there. So also what you can see is that Mint could be a significant contributor to profit over time. Also, if you look at my forecast here, what you can see is that the growth in 2022 actually is down slightly, about less than 1%. So to answer the question, there's not a lot of profit growth, though there's 5% revenue growth at the top line. So Satawat says, seems like it can grow higher with good management. Yep. And Supriya Nukala says, good afternoon, all welcome. Now, make sure you put your questions in the notes and I'll answer them as I go through. So the next thing is to look at the balance sheet of the company. And there's been heavy capex required to expand network coverage and stay ahead of competitors. It is a very competitive business and it is capex heavy. Also, there's been an issuance of long-term debt necessary to fund the expansion. Now, also, it's kind of interesting to think about long-term debt at this point, because one of the things that I would say is that when interest rates are very low, you want to borrow. And when you know that interest rates are starting to rise, for instance, the Fed's saying interest rates are starting to rise. I doubt whether the Fed's going to have enough guts to raise interest rates when the stock market starts falling. But let's just say interest rates aren't going down anymore. Now's a good time to lock in long-term debt. And that's what they're doing in 2021. And they may continue that in 2022. So let's continue on and look at what's going on. Operating cash flows are not sufficient to fund growth internally yet. Now, let's say the dividend payout ratio is about 60%, and that's delivering a solid 3% yield. So debt to equity is about, let's say, 2.8 times in 2021. Net debt to equity is only slightly less because it's not like they have a lot of cash on their balance sheet. So leverage significantly increased over time, and based upon its debt covenants, it cannot go beyond a debt to equity ratio of 3.1. Now, you may ask, what is a debt covenant? Well, when companies borrow from banks or bondholders, from people that are buying their bonds, they generally, in the prospectus for bonds, but also in the agreements for loans from the bank, the companies agree that they won't take on a certain amount of leverage. And if they start to breach some of the requirements, that they'll reduce the leverage. Now, if you want to learn how to value companies like this, check out my 6-week online Valuation Master Class Boot Camp. Class starts on March 7th. You'll learn practical stock valuation skills and apply them to value actual companies. You'll access the tools, tips, and tricks I use to become a #1 financial analyst. You'll join a group of inspiring, like-minded financial professionals, and you'll get a job through my network of thousands of finance industry leaders who I know are looking for high-quality people. You can save $402 until February 28th. Just scan this QR code to learn more and register to get the full curriculum, or just go to valuationmasterclass.com/bootcamp. So let's look at the valuation of the company. I'm going to look at our A Stotz investment research stock picking checklist. It's been inspired by Peter Lynch's book, One Up on Wall Street. 10 baggers is what he talks about, and they are stocks that go up 10 times. We did extensive research on 10 baggers and found that 9 factors drive long-term share price performance. Let's go through the 9. Number 1, management has a proven commitment to growth. This is good. Management focus on increasing coverage and winning over subscribers has been strong. The past 5 years revenue CAGR was about 6%. Next, growth. Product and industry can support a decade of 10% annual growth. Moderate. Mobile penetration is high, but broadband and FinTech investment could unlock some growth. Number 3 is sustainable, that the competitive strategy creates sustainably high gross margins. Moderate. Market is with 3 players. It's very concentrated. However, new entrant ditto could start a price war. That's a risk. Next is quality, number 4. Good earnings quality, non-core items are small or non-existent. Good. Low fluctuations in profit. Net profit has been consistently positive. Number 5, efficiency. In the long run, sales grow faster than assets. That's weak. It's a heavy fixed investment business, and basically asset turnover is pretty low at 50%. Number 6 is tight. Relatively low cash conversion cycle. Negative is best. This is good because cash conversion cycle is negative because most of these telecom companies don't have inventory. Cash flow, number 7, operating cash flow is consistently positive. Moderate. Consistent operating cash flows, yes, but they were not always strong enough to cover the investing outflows, meaning they had to borrow or raise capital. Capacity, number 8, the company has access to capital to fund growth. This is weak. There's leverage is significantly increased, and it's getting close to the debt covenants. So they've been pushing it pretty hard. The point is that if they really wanted to raise capital or raise debt to grow, it's going to be a little bit harder right now. So that's weak. And number 9, inexpensive. Valuation is reasonable. We want to avoid very expensive stocks. Here it's moderate. It trades in line with the PE and price to book compared to Philippine telcos. And ROE, though, is slightly higher. So free cash flow in 2021 is likely to end up negative due to an increase in capex, but should come back positive again and then grow massively from there. It's just a matter of the amount of capex. That's really a big driver right now. So the forecast assumptions, well, similar to consensus, I expect stable revenue growth over the next few years. I'm a bit more optimistic on margins as I expect the third competitor, Ditto, will not be able to scale fast enough to really hurt margins. Over the long run, I assume Globe to grow in line with population growth, which is about 2%. That's my terminal growth rate. So a cost of equity of 11, terminal growth rate of 2.0, and 2%. So the free cash flow valuation comes out to about 3,472 Philippine pesos. That's 11% upside. The bull case is 18% upside, and the bear case is 5% upside. So this stock, I would say, is not a 10-bagger. It's not going to go up by 10 times. But the fact is, it's a stable performer in a portfolio with a good yield and a little bit of a kicker that could come from Mint. Let's look at the world-class benchmarking scorecard, where we identify a company's competitive position relative to global peers. We use a composite rank of profitability and growth called profitable growth. The scale is from number 1, best, to number 10, worst. And I'm looking at it, and when we compare this company against 270 large consumer communication services companies worldwide, it's ranked as a 3. I consider world-class to be a number 1 or a number 2, so it's just below world-class. Profitability is about a 3 also, so above average, and growth of earnings is, in the past 12 months, about a 4 ranking. Average would be roughly 5. So it's above average on all measures, but not a knockout on all measures. So what are the risks? Well, the key risk is intensified price competition. Less than expected return on capex in a capital-intensive industry would also be a problem. An overestimation of profit contribution from Mint investment, if it really wasn't making profit, that would hurt. And failure to keep up with technological changes. The conclusions. The company recognized the potential broadband to provide solid growth opportunities. With the potential IPO of its FinTech investment Mint, the share price could see another surge. High ROE could justify slightly expensive valuation. So let me ask you, can Philippines' largest telco company, Globe, deliver on its high growth prospects? What do you think? Let me know in the comments below.